Morning. My name's Patrick Malcolm. Welcome to all our clients and guests joining us today. I'm a senior partner at GFM Wealth Advisory. I'm very fortunate today to have two guests from Perpetual Investment Management today. Vince Pizzullo, who is the head of equities and the portfolio manager of the Perpetual Equity Investment Company, which has the ASX code of PIC. Vince joined Perpetual Asset Management all the way back in July 2007 as an analyst, and since that time has covered the chemicals, diversified financials, banking, telecommunications, buildings, materials, and REIT sectors. Before joining Perpetual, Vince was a senior portfolio manager and analyst in the large cap Australian equities team at Deutsche Asset Management, and then the top 100 equities team. In addition, he had stock research responsibilities across many sectors. Vince was also a portfolio manager for a number of client portfolios and researched international stocks as part of the international equity division of State Super. And before that, Vince worked in corporate finance and foreign currency for Monty Cashy Australia Limited. I hope I got that right. Vince has a Bachelor of Commerce with a major in economics and finance. Thanks for joining us today, Vince.
Thanks, Pat.
And we've also got Alex Patton. So Alex is a co-portfolio manager for the Perpetual Pure Microcap Fund. Before that, he was an equity analyst at Perpetual, covering a range of sectors, including telecommunications, media, and retail. Alex joined Perpetual Asset Management in August 2015 after completing the graduate program within the Perpetual finance team and working in several management and financial accounting roles. Alex has a Bachelor of Accounting from the University of Technology in Sydney, and like most good fund managers, he's a member of the Institute of Chartered Accountants. Thank you for joining us, Alex.
Thanks, Pat. My pleasure.
Now, before we get the webinar started today, we also just need to share our disclaimer, which is effectively everything we're talking about today is general advice in nature. If you have any specific questions about the presentation today, please contact one of the advisors in our office. Now, before I start asking Vince and Alex a range of different questions, I just wanted to highlight the performance of the two particular investments that we're talking about today, which is the Perpetual Equity Investment Company and the Perpetual Pure Microcap Fund. So Vince's listed investment company, the Perpetual Equity Investment Company, has produced a return of 9.6% per annum since inception, which is superior to its benchmark, the ASX 300 Accumulation Index, which has produced 8.1% per annum since inception. Now, what that 9.6% excludes, which Vince will talk a little bit about later, is a significant amount of franking credits, which totals 17.57% since inception. Alex's fund, the Perpetual Pure Microcap Fund, has produced a return of 16.8% per annum since inception, which is more than 10 years ago, which has comprehensively beaten the ASX Emerging Companies Index, which has averaged only 7.84% per annum. Now, one of my frustrations is an annualizing of numbers and sometimes missing the compound effect of that performance. This fund has produced a return of 357% since inception, cumulative, versus only 109% for the benchmark. And just to highlight some years of recent returns, the COVID year, which was an unbelievably tough year for investment markets, this fund held up unbelievably well, producing a return of only negative 2% when the ASX was down about 8%. Hit back really hard in the year ending 30 June 2021, making a return of 49.11%. For the year ending 30 June 2022, which is an unbelievably tough year for small and microcap stocks, broke square, pretty much producing a return of 1%. And in what has also been a very tough 12 months for small and microcap shares, where the small cap market is down about 15% and the emerging companies is down about 6%, this fund has produced a return of 1.33% for the last 12 months, ended 31 May 2023. Now, that's enough about the historical performance of these funds. We're going to start with a question to you, Vince, a very, very easy one to start with. And that's when you turn on the news, there's lots of noise in the economy at the moment, probably more than usual. We've got the war in Ukraine, perpetual discussions around inflation. We're coming up to an election in the US. So starting with the big picture, what do investors need to know about the economic backdrop at the moment?
Thanks, Pat. You're correct. It is noise. and sometimes there is so much information, it's almost unusable. And that is one of the jobs that we do. We try to break through that and just focus on the things that we think we can control and forecast. Trying to forecast macroeconomic activities. Well, if you think about it, think about the Reserve Bank or the Federal Reserve, they've got hundreds of thousands of economists and they still can't get it right. So let's just let the experts try and get it wrong, and we'll do the things we think the market's going to focus on. So you did mention inflation. You think about for the last 40 odd years, prior to the 70s, that period, inflation was pretty devastating to the underlying economy and to returns for investors. Actually, the market traded on about 8 times PE in the 70s because of inflation, and we had stagflation. So where we are today is you've got to think about, if we just backtrack a bit to COVID, you had extremely expansionary fiscal, which is the first time since prior to the GFC. Remember, we were living in a world of austerity for 12 years, and with expansionary monetary settings, which is the first time we've had that for quite a while. And that's always going to produce significant money supply growth. And whenever you get money supply growth, multiples and multiples of what they normally are, you're going to generate some inflation at some point. So this is a bit of a catch-up. So, but where we go to today is that the Federal Reserve and the RBA have worked out that they've done too much and they've stayed around for too long with their accommodation. So obviously they've had a rapid rise in rate hikes in the last 12 months. Inflation's proving to be very sticky in a sense that services inflation is the biggest contributor, and that is wages. And everyone would have seen the Fair Work Commission's come out in the last couple of weeks, and they've pegged award rates at about 5.75 plus super. So you think about that for companies like a Woolies or a Coles that have more of a casual workforce or a unionised workforce, that's a high cost bar to sort of try and get over. So we're sort of like in a period now that post a huge accommodation, we're trying to tighten things up. The problem we've got is actually most governments are fighting against the central banks. They're still quite expansionary or not trying to rein their spending in. They're actually spending a lot more. And that's just going to keep inflation plugging away. So we sort of get, look, if they're the policy settings at the moment, the possibility of a massive spike up in inflation is probably gone, but it's going to be a lot stickier. And for us as investors, these rates we're seeing today of 4.5% here, etc., they're normal. People have gotten used to the fact that 2% was normal. That's never been normal. You go back 100 years, 4 to 6% is normal. And for quality and value investors like we are, we prefer a bit of normality, because what it means is people have to take a pretty decent view on the prospects of their companies they're investing in, because there's a real cost now to getting it wrong. If you've got quite a bad balance sheet and you get it wrong, you're going to probably go out of business. Whereas before, when you had very low rates, any business could get up, etc. So we're in a world now where the Fed is sort of like, and the central banks are fighting with the government, trying to cool things down. Historically, what usually happens, because inflation is not moving down fast enough, is that you need about a 300 basis point move or a 3% move up in unemployment to get inflation to break a bit. You are trying to deal with, this is more about behavioral economics than anything else. You're trying to change people's expectations, and you need to shock them a bit. So we haven't had much of a move in unemployment, actually, if you look everywhere we've got, even though I've had significant increase in rates. And that's concerning, because the longer we go on without actually having a shift in the underlying unemployment rate, and therefore that will mean that inflation will take a lot longer to come down. And the longer it stays higher, remember, inflation's a tax. It's a tax on all of us. Everyone might be happy having 4.5%. You're probably getting 4.5% of your cash account in the bank. Unfortunately, inflation's 6%. So you're technically going backwards. So the longer it stays where it is, the market's sort of suggesting, we're going to do a soft landing. I don't think I've ever witnessed a soft landing in a recession in my life. I'm not that old. I am old, I'm 50. But, I had one guy describe it perfectly, that trying to get a recession soft landing is like jumping out of an airplane without a parachute. The probability of having a soft landing is pretty low. So if they have to go to where they need to slow things down, it's going to be a bit difficult. Now, for us, while it sounds quite sanguine, that's sort of what we look for is opportunities in the market, because things will get a bit mispriced. Some things will be thrown out, and that's when we can, we've got a big team here. We pretty much value every company, all the companies that are in our quality universe. So we look for opportunities to buy things which have overcorrected. So that's where we are today. You tie into other things like decarbonisation, all those big things that everyone likes to talk about. These are all contributory factors to instability in the world.
So amongst that backdrop, Vince, which is complex to say the least, for you, Perpetual, what are the big themes and what are the red flags in investing at the moment?
So the red flags are that the market, and particularly the sell side, is over optimistic in their numbers for the market. In particular, margins. The margins. What's happened now is because the sell side isn't doing a great job forecasting, and the companies are being very reticent to give any guidance because it's so unknown. The future's pretty hard to predict, more than normal. Is that the margins that the market's got for a lot of companies are too high, right? We had significant gross margin expansion during COVID. Remember, because costs were pretty under control, but you had significant, people were paid to stay at home and spend, right? So margins are overstated, particularly gross margin levels. So that's going to have to normalise over the next couple of years, and it's done by inflation, right? Inflation will normalise those margins because they're getting to a point now it's hard to push on prices, increasing prices still, whereas inflation always lags in readjusting. So you'll have margins start to squeeze in the next 18 months. Also, the market's been pretty healthy for the last 6 months to 9 months. It's a pretty decent rally. So you've seen it's all multiple expansion. So the PE of the market's actually gone up in this period when inflation is extremely high. It's counterintuitive. That's not how it's meant to work. But you get these sort of hope rallies in these sort of markets where I can tell you a lot of the market participants wouldn't even know what inflation is. They're quite young. And they assume that it automatically adjusts back to, if you think of it, the playbook from post GFC to 2020 was, we're going to be, with rates will go back to 2%, inflation will be 2% pretty quickly. But it's very different. And the reason it's different is there are more rigidities economically than we've had prior during that period. I mentioned decarbonisation. So everyone's trying to convert a hyper-efficient energy system to a very inefficient energy system. That's going to be inflationary, right? Then you've got, and we all know this, is government intervention is actually increasing. We look at the gas market that's happened here. The government's come out with capping gas prices at $12 a gigajoule here, and they expected that the market would continue to supply gas at that point. Well, what's happened is the owners of the capital, us equity holders, the owners of the capital, are saying, well, no, you're capping our returns. We take all the risk. We're just going to reduce supply, right? So whenever there's government intervention, you get some pretty perverse outcomes.
Absolutely.
So we're actually, some of the work we've done is that we're more than likely to get blackouts next year in Australia on the east seaboard, most definitely, because gas is being, exploration is being reduced. Companies are sending capital offshore rather than invest here. Yesterday, Woodside Petroleum, the biggest oil and gas company we have, has chosen to go develop a field in the Gulf of Mexico in partnership with the Mexican government. What does that say about the Australian government if you're taking that, willing to take that sort of risk, right? So we're starting to get these themes where capital is finite and it's going to go seek the best returns. And unfortunately, at the moment, when you have government intervention, you're going to get perverse outcomes where capital is going to flow elsewhere. So what we're looking at, say, that example of gas capping the price. We've bought some AGL in the PIC. We've got Iluka in the portfolio. I could talk about that later at some other point. And we've got some Santos, right? Because initially it hurt them, but we feel like it's coming back to them. The opportunity. So
understood. Alex, to you, I guess the question with the Microcap fund, which effectively has outperformed because of its performance in really tough markets, how do you look to protect the portfolio of stocks that you manage in this tough economic backdrop?
Yeah, so I mean, a key part of how we invest at Perpetual across all the funds is that all investments must pass our 4 quality filters. And we've had those same quality filters in place for almost 30 years now. So we're looking to invest in quality businesses, so businesses that operate in good industries that have got some pricing power and have a decent market position. We're looking for businesses with strong and conservative balance sheets, and we've got quantitative hurdles around net debt to equity and EBIT interest cover. We spend a lot of time assessing management and board quality. So we look at their experience in prior roles, their track record, and also importantly, sort of analysing the incentives that management have. And then finally, we'll only invest in profitable companies, so companies with proven business models. And, you know, as Vince ran through, clearly it is a very uncertain environment at the moment. We definitely don't want to be owning any businesses that are reliant on banks to extend funding or that aren't generating enough cash to sustain themselves. And when we talk about balance sheet strength of a company, we're not talking just about the level of debt on the balance sheet. We're looking beyond that. We're looking at what assets they have that they can potentially realise if required. You know, whether those assets are actually worth more than book value that they're listed on the balance sheet at. We're thinking about the structure and the duration of the debt itself, and we're also thinking about the gearing position of the company relative to the type of company that is. So what I mean by that is, you know, we don't think that retailers in general should carry much, if any, debt. You know, those businesses have got a lot of lease liabilities generally. Demand can be quite up and down. You know, on the other hand, there are some other businesses out there that have, you know, more stable revenues, you know, diversified customer bases, etc., that can sustainably carry a bit higher level of debt. So we also think about, you know, the type of business relative to the balance sheet. And look, another way that we protect the portfolio is around being really focused and disciplined on valuations. So what we pay for businesses. And a business, you know, might have a lot of defensive qualities and characteristics, but if investors pay too much, then it's not going to prove to be a defensive investment. And we're really trying to focus on understanding what risks we are being paid to take when we're looking at stocks based on the share price. So, you know, there are some consumer-facing names today in the stock market that, you know, face a very uncertain, certainly next 6, 12, 18 months, but that may have already been sold off aggressively and are already trading on very depressed valuations, such that, you know, we think they'll prove to be good investments under, you know, the vast majority of economic scenarios from here.
Understood. And that really comes through in the process here, doesn't it, Alex, in terms of...
Yeah, I just wanted to highlight... Sorry.
No, that's okay. Yeah, go on.
Yes, no, sorry. I just wanted to highlight, the up and the down capture as we've got here on the slide, which is since inception, and that's measured on a monthly basis. And in essence, it shows the fund captures, you know, 100% of the market returns in a rising market, but only half the market returns in a falling market. And I think that's a function of, you know, some of the things I spoke about and the focus on balance sheets and downside protection.
Absolutely. Well, look, and we spend lots of time when we research these types of investments, Alex, focusing on this. You know, obviously protecting capital when markets are falling is great, but it also gives you the ability to compound off a higher base when things return to normal. So, I guess linking to that, I guess you can sort of break investing into 2 parts. If you can have, you know, binary good times and bad times, you know, protecting the portfolio when times are tough, and then growing the portfolio when times are good. And look, most of our clients are familiar with the fact that these tough times can often present opportunities for the patient investor. What opportunities are you seeing at the moment?
Yeah, so we're obviously active investors. So we view volatility as as good for us. It throws up opportunities for us. And if I think back to, that period in early 2020 when we had the sell-off around COVID, the turnover in all the portfolios went through the roof, and we were able to buy a lot of great businesses that we'd previously judged to be too expensive. So as a team, as Vince mentioned, we've got a large analyst and portfolio manager team here. We've always got a wish list of businesses that we're doing work on that we'd love to own at the right price. So over the last 18 months, we've seen the large cap index materially outperform the small ords. You can see that in the chart on the slide. And there's a couple of reasons for that. So firstly, obviously, the composition of the indices is different. The big four banks make up around 20% of the ASX 200. And those businesses have really benefited from the rising interest rate environment that we've seen over the last 18 months, as they've seen, good earnings growth on the back of net interest margin expansion. And then secondly, as financial conditions have tightened, investors have moved out of less liquid, smaller stocks, and that's also contributed to the underperformance of small cap names. And when we, when we speak to others in the market, anecdotally, we know that in general, investors are quite defensively positioned at the moment. Pretty high cash levels, larger weightings to bigger, more liquid stocks. So that the second chart back on the other slide shows the valuation dispersion in the market between the top quintile of stocks and the bottom quintile. And in simple terms, it's basically the difference between expensive stocks and cheap stocks. And as you can see, there's been some compression in that spread between expensive and cheap since late 2021, and that's coincided with a good period for value investors. But I think the point is there that the spread is still materially larger than it's been historically when you look back to pre-COVID. So look, we don't have a crystal ball, unfortunately. We don't know when markets are going to bottom. But we do know that markets are always forward-looking, and we think it's likely that the smaller end of the market is going to lead the rebound when investors decide it's time to put a bit more money to work. So in that light, we're seeing plenty of opportunities, attractive opportunities in the small and micro cap space. We've got a slide there that shows the fundamentals of the micro cap portfolio at an aggregate level. And you can see that from a valuation perspective, the forward price to earnings ratio of the fund is around about 8 times. I think that's the cheapest that I've seen in a very long time, versus the index up around 17.5 times. So we think that that's a really good starting point in terms of future returns for the fund. And I'd also point out, which is probably quite unusual for a microcap fund, the fund has quite a substantial dividend yield and good franking levels as well.
And very attractive on the other metrics as well. Alex, price to book and ROE too, which sounds a bit counterintuitive that you're buying these businesses on a cheaper level than the index, but they have a better return on equity. Yeah. Can you give us an example of a stock that looks well priced and has some tailwinds in your opinion?
Yeah, absolutely. So Probiotech is a business that we own in the microcap fund. It's a pretty straightforward business. What they do is manufacture and pack pharmaceuticals, both prescription pharmaceuticals and over the counter. It's if you think about their key customers, they're the big pharmaceutical names, like Johnson & Johnson and Pfizer. And for Probiotech, their main facility is down in Melbourne at Laverton. The business itself was founded in the late 1990s by a fellow called Wayne Stringer, and 2 of his sons, Wes and Jared, are currently the CEO and the CFO respectively. So the family is still heavily involved, and the family still owns about 22% of the business. And you mentioned sort of tailwinds there. For Probiotech, and we know that the vast majority of pharmaceuticals consumed in Australia, probably 85 to 90%, are manufactured offshore. China and India are big markets. But even before COVID, there was a push through the industry to increase domestic manufacturing of pharmaceuticals. And COVID really only added to that or accelerated that shift on the back of all the supply chain disruption and high shipping costs and things like that we saw through COVID. And in addition to that, as you can appreciate, the federal government has taken a renewed interest in the last year or so around ensuring that pharmaceutical companies have enough stock in the country on hand for those prescription medicines. So outside of probiotech, there's not many, there's not much manufacturing capacity in Australia. There's a few small competitors, but there's not a whole lot of capacity, and it's actually quite difficult to get a facility built. More so around the regulatory side of things with all the approvals and sign-offs they need to get
Understood
on these sort of facilities. So we think, they're in a pretty good position. That's one that we like at the moment.
Good. Now, Vince, Alex has hijacked this presentation. It's becoming a bit small cap centric, but nonetheless, that's okay. PIC has a very, very diverse investment mandate. How are you looking to exploit this small cap sort of opportunity at the moment through PIC?
Well, as you said, we can pretty much go anywhere along the cap curve. We're not like a top 20 fund, etc. We'll take advantage of, and also because we can go up to 35% offshore, we can really cherry pick the best ideas we can find. In small caps, I've been leaning into some ideas in small caps, increasing the weights like Bapcor and things like that, which have trading at multi lows again. Has a bit of Bapcor's a bit of retail exposure, but it's only 20% of the business. But that's probably the part that's under pressure. So because of 20% of the business, the market's willing to throw the equity out today, and they want to wait. So that's perfect for us. It's a it's a high quality business in that it's auto spares. It's got the rest of the business is basically is a trade business, which is pretty impenetrable as a business model. Amazon's had a few cracks at that in the US and have not been able to break into and take share off AutoZone and O'Reilly and those businesses in the US. And AutoZone, I'd say go have a look at their annual report, read about their history. It's one of the best companies in the US, and it's a parts business, third-party parts business, incredible business. Anyway, I thought I might highlight one of the stocks in the portfolio. This is Iluka. People may know it. It's a very old company. We've owned it for a little while. They spun out their iron ore royalty a couple of years ago into a company called Deterra, right? Yep. We were pretty involved in engaging with management on that and the board. It took us over 12 to 18 months of discussions with the board. Don't forget, with Perpetual, we tend to be quite active owners of stocks. If there aren't catalysts within the business and we're seeing problems with the board or management, we will get involved. Our history has been that we are quite, we can be quite forward in our views because we want to protect our investors' capital, and we want to be collaborative with the company sometimes, but sometimes you need to be a bit more aggressive. With Iluka, they were listening the whole time. That's one of a great board and a great management team. They're very steady about the way they do things. So Iluka is a mineral sands company. So basically, they produce zircon and rutile. Rutile goes into basically it makes titanium dioxide feedstocks, which goes into multiple of industrial purposes, plus also paint and those sort of things, titanium dioxide being one of the elements of paint. Obviously, it's got housing-related exposure in mostly China and the US. And they also make a zircon, which is the hardening agent for basically ceramics. It's a hardening agent. So it's a very simple business. Globally, grades of mineral sands have been declining for the last several years, and there's a lack of supply coming. So we're actually going to a period where the zircon and rutile market's going to be under supply. So prices stay pretty strong. But the reason we like it is the management's actually taken a bit of a direction change in the business, in that in the process of producing zircon and rutile, you have a lot of tailings, and the tailings they've been producing is zinc called monazite. Now, they've been storing this thing in Ineabra, a place in WA, and it's been basically a byproduct. It's a cost. But what's happened is within monazite, you've got a lot of rare earths. So now that with electrification and EV growth, etc., rare earths go into magnets production, right? You need rare earths and you need heavy rare earths to produce magnets. So anything from a wind turbine to any electric vehicle, they're going to have magnets for the motor, etc. So it's actually the single largest inventory of rare earths in the world, which is sitting on site, unprocessed, ready to go. So what they've done is Australia's got a history of digging stuff up and just shipping it out as a basic product. What they're going to do is they're actually building a rare earth refinery. And why it's important is the chart on the right there, you can see it shows you where most of the processing capacity is. And this is the main issue here is China is, of that 62,000 tonnes, China is 52,000 of it. So there's a problem. The Western world has got we're more than happy to let China process the rare earths and turn them into a product and try and buy it off them. And the main reason is it's actually quite a toxic way of doing things. It's actually, the process is called cracking and leaching. That doesn't sound great, does it? No. So it's quite a toxic element. So Lynas, everyone might know Lynas, the company Lynas, which has built a refinery in Malaysia. Well, what's happened is the Malaysian government said, we actually don't like you sending your Mount Weld in WA, your product up here, and then once you crack and leach it, leave all the tailings in Malaysia. We want you to do it in Australia first. So now they're being forced to build kilns in Australia to pre-process it. So with Iluka, they've been given a $1 billion non-recourse low-interest loan from the Australian government to build this rare earth refinery. It's going to come online basically by FY25. And why we think it's like sort of company changing is that at the moment, as I said, it's a byproduct. They make no money out of it. It sits in a tailings dam. So for zircon and rutile, they'll sell it for basically between $1,500 and $1,700 a tonne, right? So with NdPr, which is neodymium and praseodymium and other things like terbium, these are all rare earths. You sell that for about $80,000 a tonne if you evaluate it and process it to an actual ore which can be used to make magnets. So you can see that the total market is 62,000 tonnes of rare earth refining. They're building a 17,500 tonne refinery in WA, which has 10 years of supply sitting on the site. And they've also got 2 mines under development in Balranald in New South Wales and Wimmera in Victoria, which would give them decades of supply of rare earths and mineral sands. They'll be one of the only fully integrated, vertically integrated rare earth producers in the world. And fortunately, all their assets are in Australia, right? So what's going to happen is you're going to get a two-tiered market. It's happened in the nickel market, where any nickel that's produced in Indonesia via a very toxic process, which uses arsenic, etc., and those things, or China, cannot be sold to a Western country now, because all the car manufacturers can't buy it because you can't confirm the security of supply, but also the way they've processed it. So what's going to happen is the West is going to have to build its own supply chain, and it's happening in lithium. So lithium is going to have to be processed in the West, and with rare earths, there's virtually nothing being processed in the West. So Iluka by next year will probably be one of the largest producers with a refinery in Australia of rare earths anywhere. So the benefit of this is Iluka has a net cash balance sheet of $500 million. They can fund it itself, but they've got the loan from the government. It also has a 20% ownership stake of Deterra or Iron Ore Royalty listed company. And that's about $500 million. So it's got $1 billion of liquidity anyway. And the benefit of that is that it can finance this pretty easily and not have to self-forward its production. Typically with explorers, what they'll do is when they find a deposit, they'll basically start to sell forward their production at a discount to the market price so they can get financing. The benefit to Iluka is they can sit back, wait till they're pretty much close to production, then go see all the auto manufacturers in the West and say, right, this is the price we're charging. Do you want access to it? So they'll be able to maximize and give full leverage to the NdPr price. And the NdPr price is predicted to go close to basically $90,000 a tonne, right? So it's highly value-added material. And basically by 27, 28, we've got this business, the rare earth business, being larger than the mineral sands business, right? And you're paying 4 times EBITDA for that exposure. It's not a very, because it's a resource company, people put on a very low multiple, but we think that you're going to get a particularly large re-rating in the stock, when the thing starts to produce, the market won't pay for it today. They want the refinery up and running before they're willing to pay for it. Whereas we're sitting there going, as Alex mentioned, it's got a great balance sheet. It can finance it itself, and the management is of high quality. So Iluka's a pretty large position. It's 5% of the pick. So it's a pretty punchy position for us when we actually quite like a lot.
Understood. Now, large portion of our client base, Vince, are self-funded retirees, and they love dividends and franking credits, hence why they're fond of PIC. Can you talk us through how or a little about the income and franking credits that PIC has and is producing at the moment?
Yeah, look, when we initially designed, we spoke to the advisors. When we designed the PIC originally, we said, right, let's create an investment vehicle which SMSF investors can use, because obviously the problem with trusts is sometimes they pay out all their gains in 1 year and then they've got nothing the next year, right? We wanted to set it up. Historically, Perpetual's vehicles, our average distribution in a lot of the funds we run is about 4% anyway. But the volatility of that 4% is quite high, depending on the realised capital gains. So obviously in a LIC structure, we can hold some of that back and stream the dividend to be a lot more smoother. So over the last since inception 2014, we've paid out about 37 cents a share in dividends, right, which is about a third of the capital. More importantly, all that's been fully franked. So if you gross up for the franking, it's 53 cents a share. The stock's trading at about $1.20. So we nearly paid just under 40% in dividends back to the investors, right? And we've actually grown the capital in spite of that, right? So we've designed it so that the SMSF investor can expect a reliable dividend, right? Have exposure to both Australian and global securities, but also a bit to Alex's point, we're quite conservative when we need to be, in a sense that we want to protect the capital. So having an ability to go to 25% cash helps us do that as well. So 2 years ago, we said that we wanted to build a buffer in the dividend reserve, which we've done. We've now basically got 4 years of dividends parked away, fully franked, that we can pay at about a 3.2 to 3.3 cents per half level. So that's really important, because sometimes markets will roll over and dividends in the market will probably be cut. But because the PIC's put away 4 years of dividends, we want to be able to maintain that through. We'll be able to pay that pretty much through the cycle. So that's why we designed it this way, and that's why we've been pretty reticent to. We could have paid more dividends back, but we'd rather hold a little bit back today. It's still on a pretty healthy yield, about 4.5%, 5%, fully franked. So holding a bit back today to benefit the investors so that they can rely on the dividend going forward.
Yep. Now, we're going to close off with a buy, a hold, and a sell. Alex, Vince stole a little bit of your thunder because he jumped the gun with Bapcor, but that's okay. But can you talk about Bapcor and what you think about the business at the moment, and whether it's a buy, hold, or sell for you?
Yeah, sure. Based on Vince's comments, probably no surprise that Bapcor's a buy for us. It's an automotive aftermarket parts supplier, and Vince mentioned the retail part of the business is the Autobarn network. That's about 20% of revenues. The key part of the business is the core trade business, where they're supplying parts to mechanics all around the country, Australia and New Zealand. And look, we think it's a really good business. The market structure there is very consolidated. It's Bapcor and Repco that probably have 60% market share, very rational. Demand is really driven by people going out getting their cars serviced, which is quite non-discretionary, as you can appreciate, and they've got good pricing power. So for the mechanics, it's all about getting the right part quickly, and the price of the parts are ultimately passed through to the consumer. So we think it's a really good stock, good business for the environment that we're in. And the management team there are quite new. They've announced a pretty ambitious strategy around, adding an incremental $100 million of earnings through better pricing and procurement. Look, we think it's the right strategy, a huge opportunity, and the market's very skeptical at this point. Really,
that's the reason for the softness in the share price in recent times, Alex.
Yeah, so it's a combination. Yeah, it's skepticism around their strategy, but it's also, as Vince mentioned, I think it's to some extent it's been lumped in with other discretionary retailers. We've seen some pretty ordinary trading updates for some retailers. Clearly, consumer is starting to roll off, but that's a relatively small part of this business. Only 20% of the business is the Autobarn network. The bulk is trade and wholesale, which is quite stable, which we think is sort of being overlooked by the market. So yeah.
The next one's PWR Holdings, ASX code PWH. Alex, buy, hold, or sell?
Yeah, that's a hold. You know, it's a stock that we've owned in the past across a number of the funds, including in the pick. It's a really interesting little business. It designs and manufactures cooling systems, so things like radiators, mainly for cars, but there's more and more use cases, you know, for example, in aerospace or defense. It was founded in the late 90s up in Queensland by Keys Wheel and his son, and they are most, if not all, of the Formula One teams. So they're recognised as a world leader at what they do, which is, you know, pretty impressive. Strong earnings, revenue growth, you know, good margins. The balance sheet's net cash. You know, the founder Keys still owns close to 20% of the company. So there's lots of things to like about it. I guess the part where we struggle at the moment is just around the valuation. It's trading on a sort of mid-30s times price to earnings. Ratio. You know, we do think it's all these new markets. It's not going to be a straight line. You know, the success is going to be lumpy, and we don't think there's quite enough, you know, margin for error in the valuation at the moment. But it's one that, you know, we'd love to own at some point in the future at the right price.
Fascinating how the market's knocking around Bapcor, but loves PWH so much, but nonetheless.
Yeah.
Now, the last one. Now, my kids are going to be very disappointed in this, Vince. They would live on Domino's Pizza if they could, a 6-year-old and a 9-year-old. And you're going to call it a sell, but that's okay. So talk us through Domino's.
Look, we've done a lot of work on this in the past. We've just finished a major little project on it in the last several weeks. You know, it's a growth story, 10-year growth story. It's a favourite of the market. You know, trade up to $160. You know, peak COVID beneficiary, as everyone was at home eating pizza and doing whatever else was doing, playing games. And then it's just derated materially since then. And one of the reasons it's derated is they actually didn't increase prices during COVID, when the customer was pretty much willing to pay anything for the product. But inflation started coming through in their supplies and the products they need to make the Domino's, like cheese, etc. And what's happened is the consumer's starting to roll over, and now they're increasing prices. So the timing couldn't be worse. But the major issue we've done, and we've done some industrial analysis here, is we've compared them to Domino's UK, which is a separate listed big company in the UK, and DPZ, so Domino's US, which is the master franchisor. They also run their own stores in the US. And the biggest issue we've got with franchise businesses is when the franchisor takes too much of the profit from the franchisee, you just get this high turnover in franchisees, and you're going to struggle. And when you get likes of inflation, the franchisee's profitability collapses. Now, when you compare Domino's Australia, they take about 50 to 55% of the gain of profit from the franchisee. Whereas when you compare it to Domino's UK and Domino's US, they only take 40%. So the way it's structured is Domino's US says, look, you can go buy your supplies for your pizza, the little franchisee, from anywhere you like. But if you buy from us, because we're the single largest buyer of cheese in the US, we've got a profit pool of the rebates we get. We'll pass 100% of that on to you. So they're encouraging them to deal with them. And by doing that, they're giving them full transparency and saying, we're going to give you some profit share from what we can do for you, right? That's why the profitability on average of a franchisee in the US is about $200,000 per store, right? In Australia, it's about 100, right? And typically in Australia, their family typically works in the store as unpaid labour, right? So it's a spurious sort of franchisee model in that sense. So they've got problems, and that happened basically after the first half in FY23 in February. Pretty significant profit warning because basically their franchisee stores are less profitable. They don't want to roll more stores out, and they've got a view that they can grow at 8 to 10% a year. So now they can't do that. What's happened subsequent to that is we've done a lot of work based on the fact that the economics doesn't work for a franchisee in Australia and in France and in Germany, where Domino's Australia is. And, power prices increased materially in Europe. So the franchisee profitability is really quite poor. So it is tempting to look at that chart and go, it must be cheap, right? At 44.
75%, yeah.
Yeah, that's right. But the problem is the business model is actually quite challenged. So unless you have a come to Jesus moment where they actually go, you know what, we're taking too much from the franchisee, we're better off to take less, give more to the franchisee, then we'll actually start to grow the top line again. So what's happened is they've refused to do that, and 2 weeks ago they issued another profit warning for the full year with $80 million of restructuring costs in actual cash costs. But they still have not yet reset the economics for the franchisee. So we're of the view, their balance sheet's quite tight as well, by the way. It's got a bit of debt, right? And they're quite tight. So if we think what's going to happen is going to occur, we think there's another capital raising coming. For us to participate in something like that, we'd be quite strong in our views to say, look, we want you to reset the business, right? You need to improve franchisee profitability by giving them more. The market will accept that because look where it's trading. It's going to accept that it's on a pretty poor path. That if they can reset it, we go, okay, then it looks interesting because it's more sustainable a business. So today we're still of the opinion that it's not sustainable, that there's actually more bad news coming. The market's starting to work it out. So we're sort of like going to avoid it at the moment.
Understood, Vince. I thought you were going to say they were going to go broke rather.
No, it's going to be touch and go.
Tell my kids Domino's is going to go bust. But anyway,
don't worry. Pizza Hut's opened up in Australia as well, and they've just been taken over by a US private equity group that owns the brand in the US, and they're going to actually start rolling out pretty aggressively in Australia as well.
Good. All right. Guys, thank you so much for your time today. We greatly appreciate you taking the time to speak on behalf of our investors. All the very best for the year ahead.
Thanks, Patrick.